What happens to high-yield bond prices when interest rates rise? Imagine you bought a high-yield bond that pays a fixed interest rate. Now, picture interest rates in the economy climbing higher. What do you think happens to your bond's value? When interest rates go up, the prices of existing high-yield bonds tend to fall. This is because new bonds are issued with higher interest payments to match the rising rates. Investors prefer these new bonds since they pay more. As a result, the older bonds with lower fixed payments become less attractive. Because investors want the best return for their money, they will pay less for older bonds that offer lower interest rates. This causes the market price of these bonds to drop below their original face value. The bigger the increase in interest rates, the more the bond's price tends to decrease. Bonds with lower coupon rates are more affected by rising interest rates than bonds with higher coupon rates. Also, bonds that have a longer term until they mature are more sensitive to rate changes. If a high-yield bond has many years left before it matures, its price will likely fall more when interest rates rise. If you hold a high-yield bond until it matures, you will usually get back the full face value, assuming the issuer does not default. But if you need to sell the bond before maturity, you might get less than what you paid. Rising interest rates can make your bond worth less in the secondary market. For seniors who depend on income from bonds, this situation can be tricky. As interest rates go up, the value of their existing bonds drops, which can affect their overall portfolio. However, new bonds issued in a rising rate environment will offer higher coupon payments, meaning better income opportunities for future purchases. It's important to remember that while the interest payments you receive stay the same, the resale value of your bonds can decrease if interest rates rise. Many seniors prefer to hold bonds until they mature to avoid losing money if they need to sell early. This way, they can count on getting their full investment back while enjoying the steady income from their bonds.